In this video, I'm going to discuss an interesting choice that SoFi makes every time they make a loan. When SoFi makes a loan, they have a choice. They can either hold that loan to maturity or they can sell that loan to a partner. Now, how do they make that choice between holding versus selling? That's what this video is going to be about. I've highlighted CEO of SoFi who discusses that choice and why they make that choice in a historical perspective. And then I'm going to talk about why that could have a huge impact for SoFi stock investors. So stay tuned. You're not going to want to miss this. So here we have the CEO saying holding versus selling and investing is something that we're really focused on. And what we use is our optimizing return on equity and return on invested capital. And so when we have a choice to sell a loan at 104% or hold it at 106%, we're thinking about what is the return on equity. So we're thinking about what gives us the highest return on equity. Now, you might say, how does that work? How can they hold and sell at different prices? Well, it's because the market demand for loans changes over time. Right? Sometimes investors want to invest in loans, right? They want to hold loans because it gives them a steady return on investment. They get, stated income and they know what that income is going to be. But sometimes investors don't want to invest in loans. It could be because they're afraid there's going to be a higher level of defaults. It could be because they have better opportunities elsewhere. It could be for a number of reasons. And during those times when demand for investing in loans is lower, they offer lower prices to SoFi to buy those loans. And when the offers are lower, SoFi chooses perhaps to hold that investment instead of selling it into the marketplace. But here's the key here. If we have room on the balance sheet, we have liquidity, we have funding capacity, we have the option to choose the best yield or the best return. We have the option to choose, but that's only if we have room on the balance sheet. That means if SoFi doesn't have the flexibility, it doesn't have the cash, it doesn't have the ratios to meet the regulatory requirements, it may not have the option to hold the loan on the balance sheet. They always have the option to sell it because that's the least riskiest option in terms of regulators' perspective, right? When they sell the loan, then it's no longer on the company's balance sheet and it's no longer a risk to the bank. So selling, they always have the option to sell it. But they don't always have the option to hold on to the loan if if it's feasible, if it brings a better return on investment. If they have the flexibility, they can hold on to the loans. So this is where flexibility gives SoFi stock investors optionality. It gives them optionality because now they can choose. And so more recently, we believe we can get about a 6% return on investment by holding the loans versus selling them at a 4% return on asset. So what the CEO is saying here, what you can infer from this statement is that in the marketplace right now, it makes more sense for SoFi to hold the loans on their balance sheet because they're getting a 50% higher return on investment instead of selling them into the marketplace because right now the market demand for loans is not good, right? And you can understand why. The Federal Reserve is raising interest rates, the risks of a recession are higher, and so investors are less interested in investing in loans that have a now higher percentage chance of default, right? So that's why demand is lower. But right now, SoFi is saying we have the flexibility to hold on to these loans. So this is good news in the sense that they have the flexibility to hold on to the loans and get a higher return on investment. But at the same time, SoFi stock investors should consider that this also means a greater degree of risk because SoFi is holding on to the loans and they're getting a better return on investment. That's true, but they're also accepting a higher level of risk, right? When you sell this loan and you get the money, there is no risk to you as SoFi, right? Let's say I make a loan for $100 and the person's going to pay me 10% for 1 year, so next year he's going to pay me back 110. I can hold on to that loan and wait for this person to pay me back, but I'm always at risk of the person just not paying me back, and so I'm going to lose that $100 that I lent out. versus I have this loan that I made for $100. The person promised me they're going to pay me back 110. If I take this loan and I sell it to somebody else for $105, I make only $5 instead of $10 on the loan, but now I have no risk because now that person owes somebody else. And if they default, then it's somebody else's problem. I've already made my money. I've made my $5. And so that's a choice. It's a give and take. Do you want that higher risk in exchange for a higher return? Sometimes the answer is yes. And it looks like right now for SoFi, the answer is yes. But for investors, it's important to remember that as SoFi continues to do this for every quarter, the more and more loans that it holds on the balance sheet, the more and more the riskiness goes up because some percentage of those people are not going to pay you back. Just something to consider, right? But overall, it's good news for investors that SoFi has the flexibility to choose, right? Choice is always good. You can choose the better option if you have the flexibility versus if you're constrained and your only option is to sell, you have to just take whatever price you can get. That's not always favorable. So it's good that they have that option, but it's something to keep in mind that as they choose this, the riskiness as an investment is increasing. All right, that's all I've got for this video. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.